everyone, my name is Rajesh and in this video we are going to have a look at various different business processes or business process cycles in Oracle Cloud ERP financial modules, or for that matter in any ERP. These business process or business cycles are going to be there in the finance and accounting domain. Now we have already seen that all these major ERPs, or for that matter any ERP software, is very process centric software. What do I mean by that? Is anything and everything that happens in these softwares, especially in the transaction centric modules, or as we call it in Oracle Cloud, the sub ledgers, these all modules are very process centric. Everything that happens can be termed or can be defined in terms of the various process steps. So we are going to see the main process cycles in this video. With that, let's begin. So the first and foremost, the most important process cycles out of these is something that is called procure to pay cycle. Now this procure to pay cycle basically revolves around everything that is purchased by the organization. Now any large organization can typically have the purchases of four types. One is the direct material, that is the material that they purchase which they use as raw material in their manufacturing process, or the material that they trade in. So for example, if any organization trades in the laptops, then the laptops becomes the direct material for them. The second type of purchases is something that is called consumables, which means the material that they do not directly use in their finished goods or trading goods, but it is something that they use for their office purposes or for their cleaning or housekeeping or stationery or administrative purposes and so on. All of that is known as consumables. The third type of purchases could be various services. For example, the utilities like electricity, internet, telephone, and so on and so forth. Or various professional services like audit services, legal services, and so on and so forth. So all these services can be purchased. That is the third type of purchase. And the fourth type of purchase is the fixed asset. So any organizations, any purchase basically will revolve around these four type of purchases or any of these type of purchases. And to make this process happen, they follow this process called procure to pay process. Now on a very high level, this process can be described in 5 steps. One is purchase requisition, the second is purchase order, third is receipt, fourth is the payable invoice or the supplier invoice, and the fifth one is the payment that is made to the supplier. So these process steps that I'm going to demonstrate in this particular session may not necessarily exactly be the same steps that I am mentioning. Some organizations may have a few more steps involved in their procurement cycle or P2P cycle. However, what I am trying to cover over here is something that is bare minimum or on a very high level. These are definitely going to be the steps in any procure to pay cycle or P2P cycle in any organization. So as I mentioned, it starts with purchase requisition. So if any department in the organization or if any employee of the organization needs some of those items that I just mentioned, though any of those four items, whether the direct materials or consumables or services or fixed assets and so on and so forth. So if any of this is required by any employee or any department of the organization, they will create some document that is called purchase requisition. And this is basically to formalize all the requests that are received from various departments and various people in the organization. So all of that comes in the form of purchase requisition as a document. Now, since this purchase requisition is an internal process, it does not need any accounting or it does not even involve any external stakeholder to the organization. All of these purchase requisitions are then sent to the purchasing department in an organization. Now this purchasing department will have its own ways and means to find out the correct supplier to procure whatever is required by various departments or various people in the organization. Some of the times these suppliers can be scouted through the sourcing process, which also means that the organization's purchasing teams will float the RFQs or requests for quotations, demand multiple quotations from multiple suppliers, compare those quotations and then decide one final supplier. However, that's not always going to be the process. Every organization, depending upon the industry in which it operates, depending upon the nature of purchase and depending upon the region in which it operates, may have different processes of sourcing or different processes of finalizing the supplier. But once this supplier is finalized, purchase department of the organization consolidates all these purchase requisitions and prepare the purchase orders and send these purchase orders to the suppliers for receiving the goods. Now, even though there is an external party, which is the supplier, that is involved in this purchase ordering process, this purchase ordering process still does not attract any accounting. Now, why is it so? Is something that is interesting question, and you guys can go out and find out the answer why exactly there is no accounting in the purchase order process. Now, once the purchase orders are issued to the supplier, the next step is that supplier is going to deliver the goods or services to you, to your organization at the required address, and then supplier is going to send one note accompanying that particular delivery, which is called goods received note or GRN, and this GRN is then recorded into the system. Now, this GRN is the first point in time where there would be the accounting entry happening, and that accounting entry in very basic sense is inventory account is going to be debited and some sort of accrual or parking account is going to be credited. Now, in this entire processes like P2P, O2C and so on, why exactly so many parking accounts are involved is again an exercise for you. So you guys can find out what exactly is the purpose of involving all of these parking accounts. However, the accounting that happens or that should happen at the time of GRN is inventory account is debited, or any expense account is debited, or any asset clearing account is debited, depending upon what exactly you are purchasing, and then crediting the accrual account or crediting the parking account. Now, the fourth step is that supplier is going to send you the invoice document or the bill for the purchases that you have made from that supplier. And this bill or invoicing document is going to be received by the accounts payable team of the organization. This AP team is going to record that particular invoice into the system by matching it with the purchase order or the GRN that is created in the earlier steps. And that matching is done basically to establish the internal control to see that whatever you had demanded or ordered and whatever you have received, whether you are receiving the invoice only for that much quantity or you are receiving the invoice for something excess. So to maintain the internal control over that, you have this process called matching of purchase order or GRN with the invoice. The crux is that you create this AP invoice or you record this AP invoice into the system. And the accounting entry is going to be the earlier account, the clearing account or the parking account that you credited during the GRN process, that is now going to be debited and the supplier liability is now going to be credited. Last process in the P2P cycle is the payment that is made to the supplier. Now, this payment will obviously be made on the due date of the invoice. That's simply because generally in the large businesses, all the large purchases that you do will be a credit purchase and will not be the cash purchase. So every purchasing invoice will have some credit period that you will be getting. And at the end of that credit period, which is also known as the due date of the invoice, you as an organization are going to make the payment to the supplier and you are going to record that payment into the system. That is as such the last process in the overall P2P or the procurement to pay cycle. Now there can be one more process sometimes which is called the reconciliation, which is done after the payment. It is nothing but the bank reconciliation statement or the BRS process as we know it academically. However, that may not always be the process involved in the P2P cycle. But the major processes in the P2P cycle: requisition, order, receipt, payable invoice, and the payment made to the supplier. So that's it for the procurement to payment cycle. Now, just to mention, in the Oracle Cloud ERP modules that we have seen in one of our earlier sessions, this particular P2P cycle revolves around certain modules from Oracle Purchasing and certain modules from Oracle Cloud Financials. Mainly, it involves the self-service procurement, core purchasing, inventory and receiving modules from the purchasing suite of applications, and the accounts payable and cash management modules from the Oracle Cloud Financials application suite. So the P2P process spans across all of these modules. The next process that we are going to see is the order to cash cycle. Now, similar to the P2P cycle, which revolves around the AP or the accounts payable functional area, the O2C or the order to cash cycle revolves around the AR or the accounts receivable functional area. So the order to cash cycle begins with booking of the sales order. So you receive the sales order, or rather you receive a purchase order from your customer, which you by the way call a sales order from your organization's perspective. That sales order once received, you book it into the system. Now, same as purchase order in the P2P cycle, this sales order booking will not also attract any accounting entry. That's simply because it does not involve any financial consideration, so to say. Now, the next two steps in this O2C cycle, which are picking of the goods and then shipping or delivering of the goods, are involved only in case of the firms or organizations that deal in physical items. So let's say the manufacturing organizations or the trading organizations are the only ones where these two steps will exist. For the service organizations, it will directly be AR invoicing or the customer invoicing and then receiving the money from the customers. Those organizations will not have these two steps. However, from the perspective of manufacturing or a trading organization, the next step after the order booking is going to be picking of the goods from the warehouse. Now, Oracle Cloud ERP's order management or order orchestration module, or for that matter, any other ERP's relevant modules, will be capable enough to tell you exactly or to tell you automatically where to pick the goods from depending upon what has been ordered by the customer. And it will also tell you like which batch, if you are storing the multiple batches of the same SKU or the same goods, then it will also tell you which batch to pick it from based on the expiry date or based on the logics that you have set in the system. So depending upon this automated guidance that is provided by your ERP system, your warehouse workers or warehouse staff will actually go to that particular location or shelf and pick up the goods that needs to be shipped. And they will bring these goods to the shipping area or the staging area in the warehouse. Now, once that happens, the accounting entry corresponding to that movement may be created as inventory account is credited because you are reducing your inventory. And then you may debit something called deferred COGS or deferred cost of goods sold account. Now, how exactly you are going to classify this deferred cost of goods sold account is something that is an exercise for you. So you guys need to find out that in my balance sheet or in my P&L account, where exactly this deferred cost of goods sold account will appear. It's simply because it may happen that as of the year end, you may have removed some inventory from your warehouse and you have brought that to the staging area. Thereby, you have passed this particular accounting entry by debiting the deferred cost of goods sold account and crediting the inventory account. However, you have not passed any subsequent entries in the O2C cycle. So it is quite likely that as at the year end, you may have some debit balance in your deferred cost of goods sold account. So it is for you to find out and tell us that where exactly this deferred cost of goods sold accounts debit balance will find its place in your final accounts. Moving ahead, the next step in the O2C cycle is shipping or delivering of the goods that you have got at the staging area. So you will do the required packing and then you will ship or deliver these particular goods. Now at this stage, the accounting entry is going to be this deferred cost of goods sold account which was debited in the earlier accounting entry or in the earlier process step of the O2C cycle will now be credited and your cost of goods sold account will actually be debited. Now, obviously, the cost of goods sold account is going to be your P&L account or is going to be your expense account. Why is it so? Because now you have transferred the ownership of the goods to your customer, and that is where you can very well book it as your consumption or as your expense. Next step in the order to cash cycle is going to be the customer invoice booking or customer invoice processing. Now, all of this previous information from the previous steps of the O2C cycle, which involve the order related information, the shipment related information, all of that is going to travel or is going to be transferred to the accounts receivable team of an organization. And then accounts receivable team is going to prepare the sales invoice or the customer invoice and send it out to the customer after incorporating the agreed terms with the customer in that invoice. And the next or the last step of the O2C cycle is receiving the cash from the customer and then applying that cash against the invoices that you have booked in your system. At the time of booking of the invoice, the accounting entry is going to be the receivable account debit or the accounts receivable or the debtors account debit and revenue account credit. Now, why exactly you will be debiting the accounts receivable account over here is mostly because of the fact that majority of your sales are going to be the credit sales. And that is where you are not going to receive the cash immediately at the time of sale, but you will need to book it as your accounts receivable and you will need to give some credit period to your debtors or to your customers. And finally, at the time of the last step of the O2C cycle, which is cash received or check received or the payment received by any other different means, you are going to create an entry which is bank account debit and accounts receivable account credit. That is how your O2C cycle is concluded. Again, in the O2C cycle, there are multiple modules from the Oracle Supply Chain Management suite of products and Oracle Financial suite of products are involved. So the first step in this O2C cycle, which is order booking, is carried out in the module called order management or the order orchestration, which is a part of Oracle Cloud ERP's Supply Chain Management suite of products or Supply Chain Management family of products. The second and third steps, which are picking the goods and then shipping or delivering the goods, is going to be created or is going to be processed in order orchestration as well as in the inventory modules of the supply chain management suite of products. And the last two steps, which are invoice booking and the payment booking, are going to be carried out in the accounts receivable module of the Oracle Cloud ERP, that is going to be a part of Oracle Cloud Financial suite of applications. Now, these two processes or business cycles, which are P2P or procure to pay process and order to cash process, are going to be the most important processes or most active process cycles in any business that is there. The other process cycles that we are going to cover them only at a high level. For example, the next process cycle that we have is the asset acquisition to retirement process cycle. Now, typically, unlike the P2P or O2C cycle, this cycle is not necessarily a sequential cycle. What do I mean by that is all the events that you can see on your screens right now may not necessarily happen for every single fixed asset that you purchase. However, broadly, if you can consider all the events that may happen for your fixed assets, then right from the asset acquisition, which also means the capitalization of the asset cycle starts. Afterwards, there could be the processes related to the asset, such as changing the cost of the asset or adjusting the cost of the asset, changing the descriptive details of the asset, depreciation, impairment, revaluation, taking the physical inventory or the physical stock of the fixed asset, and finally the retirement of the fixed asset. So all of these steps may not happen for every fixed asset that you purchase, but broadly, these are the steps or these are the features or functionalities involved in the asset acquisition to retirement cycle. Now, I am purposefully not going to disclose or discuss the accounting entries for each of these events. It is something that we are going to see in our subsequent modules. But it is very essential to know that there is this cycle called asset acquisition to retirement cycle that does exist in the Oracle Cloud Financials application. And the module in which all of these processes are done is called Fixed Assets module, that is a part of Oracle Cloud Financials or Oracle Cloud Core Financials modules or applications, which we have already seen in one of our previous videos, the name of which will be appearing on the screen somewhere over here. The next cycle that we are going to see in brief is the bank statement reconciliation cycle or the bank statement processing cycle. Now again, same as fixed asset module, this is also not essentially the sequential steps. However, in the cash management module of Oracle Cloud Core Financial modules, all of these process steps related to the bank statement processing may happen. It starts with bank statement import or bank statement upload or bank statement creation into the cash management module of Oracle Cloud ERP. Now, unlike the traditional bank reconciliation statement, how we used to prepare in our academics, the bank reconciliation process is done differently in the Oracle Cloud ERP modules. In simple words, it is done in the way that on one hand, you get entire bank statement data imported into your system. On the other hand, you have your system transactions such as the payments that you have recorded in the accounts payable module or the customer receipts that you have recorded in your accounts receivable module and so on and so forth. And then you reconcile both of these sides and then you figure out what are those transactions in the bank statement that are not existing in your system. So there may be some external transactions existing in your bank statement, such as the interest that is credited by your bank or the charges that are debited by your bank. All such processes are then recorded in your cash management module, either automatically or manually. These transactions are called external transactions. Now, after the bank statement upload, the reconciliation is performed in the cash management module, which can be done in the automated mode. Firstly, it will be tried to do the reconciliation automatically. However, not all the bank statement lines that you have uploaded or created into your system may be reconciled using the automated reconciliation process, and that is where you might need to do the manual reconciliation of some of the remaining lines or some of the remaining bank statement transactions. After the external transactions, there can be two other types of transactions that can be created in Oracle Cloud Cash Management module, which are first of all the interbank transfers. So suppose that you as an organization have got two different bank accounts and you are transferring the funds from one bank account to another bank account. In simple language, it is called a contra entry. So these contra entries are prepared or created into the system as interbank transfers. Another type of the transactions that happen in the cash management module cycle are the ad hoc payments or the payments or the receipts without any invoices. So obviously, if there is any supplier payment that is happening or if there is any cash that is received from the customer, you would have probably booked that in the AP or AR modules because that is corresponded by the invoice that you have recorded, which your supplier has sent to you, or the invoice that you have recorded in the AR module, which you have sent to your customer. However, in business, there can be some inflows or outflows of the cash that are not backed by certain such invoices. And such inflows or outflows are recorded in the cash management or treasury module of Oracle Cloud Core Financials. And lastly, there is a process called cash forecasting, which is like you decide your cash position in your bank accounts, and depending upon the due dates of your AP invoices and AR invoices, you decide that how exactly your cash flow is going to look like in next 5, 10, 15, 30 days. And that is what is known as cash positioning and forecasting, which is one of the process in Oracle Cloud Core Financial modules. Now the next steps or the next process cycles that we are not going to discuss in this video, but it is an exercise for you guys to figure out what are the steps in these cycles, are record to report cycle, expense report to reimbursement cycle, and budget to monitor cycle. So you can Google, you can find out on docs.oracle.com, and you can figure out and prepare the steps in all these cycles and what are going to be the probable accounting entries or the accounting impacts in these all cycles. We are anyhow going to cover some of these cycles as we move ahead with our Oracle Cloud Core Financials course. That's it for this session. Thank you for listening.